You have felt this before. Prices keep rising, friends sound sure. Your feed is full of winning screenshots. And a quiet thought shows up. Maybe everyone finally knows what comes next. That feeling is common. It is also dangerous if you treat it like proof. Research on overconfidence and herding says our judgment can bend under pressure, imitation, and recent success. So here is the real question we will walk through together. Psychology clearly shows up in markets. But can those patterns help you think more clearly without turning one limited observation into a rule that always works? Let's start with a moment many people still recognize: the late 1990s tech boom. Researchers watched the NASDAQ rise hard from mid-1998 toward its March 2000 peak. At the same time, two rough signs of bearish betting, short interest and the put-call ratio, fell. When prices later dropped, those bearish signs bounced back up. In plain English, after a long climb, fewer people seemed willing to bet against the market. That pattern is interesting. It matches a feeling you may know from your own life. When everyone looks confident, doubt feels lonely. But interesting is not the same as predictive. One episode is a clue, not a forever signal. So where does that clue come from? Think about your own money decisions for a second. After a few good months, continued gains often feel more believable. After losses, more trouble can feel easier to imagine. Researchers call that kind of habit extrapolation. Then add social influence. People do not judge risk alone. Evidence on local investment preferences suggests nearby peers can shape what households hold. Add overconfidence, and familiarity or agreement can start to feel like skill. You have probably felt some mix of these already: copying a friend, trusting a hot streak, or feeling smarter after one lucky call. These forces can stack. Their strength still changes by person, place, market structure, and time. That boundary is the part flashy market stories often skip. Now step back to 1929, but keep it human, not mythical. Before the crash, there was growth, new technology, rising spending, optimism, speculation, and heavy borrowing on margin. Accounts describe newer investors following richer traders and press stories, while belief in forever rising prices spread. Then October hit hard, including October 29th. If you have ever watched a boom and felt late to the party, that emotional shape may feel familiar. History fits, with herding and overconfidence playing a role. It does not prove psychology alone caused the crash or the depression that followed. Collapses are messy. They mix rational moves, irrational moves, leverage, institutions, and the wider economy. The lesson is not that crowds are always wrong. The lesson is that confidence can travel faster than careful thinking. A longer market record adds another layer, and it helps us stay honest. On the New York Stock Exchange, an annual short sales measure rose from about 1.2% in 1960 to about 6.6% in 2002. That rise may reflect the growth of hedge funds and other long-short strategies. Because the baseline changed so much, researchers studied changes in the ratio, not the raw level as a fixed signal. Those changes tended to move opposite annual market returns, with a reported correlation around -0.51. That supports the idea that aggregate bearish positioning can shift with recent performance. It also creates a puzzle you should keep in mind. Short interest can look contrarian for single stocks, yet behave differently across the whole market. Same word, different meaning, different lesson. Here is the story many people want next. If markets are emotional, then skilled stock pickers should win when fear and greed get loud. The available evidence does not justify that leap. Research separates true stock selection from factor timing, and from funds that stay close to an index while still charging for active choices. Comparisons also depend on the benchmark used, the holdings data, the time window, fees, and the market segment being studied. One Russell Index series even starts in December 1986. That date marks where the data begins, not a special market event. If you have ever paid for active management because markets felt chaotic, this is the part that matters most. Chaos and bias do not automatically mean a manager will outperform after costs. A fair skeptic will ask the hard question: if these biases are real, why can they not tell us when to buy, sell, or bet against the crowd? Because spotting a tendency is not the same as forecasting its market effect. Overconfidence may lead to too much trading, underestimating risk, or bad timing. Herding may increase imitation. You may have done versions of both without calling them by those names. But prices also respond to information, institutions, liquidity, regulation, and policy. Different people can show the same bias in different ways, and their trades can cancel out. Even a strong historical link can weaken when incentives, access, or popular strategies change. Context is not a footnote. Context is part of the result. That is why simple always rules fail people who have lived through more than one market mood. So here is the real turn. The strongest useful insight is not that the crowd is always wrong, or that opposing the crowd unlocks easy profit. It is that market behavior can create conditional patterns. Their meaning depends on what was measured, when it was measured, and who was involved. The dot-com evidence helps because it links rising prices with falling bearish positioning. The longer historical series helps because it shows a related pattern and also a conflict with stock-level behavior. Neither gives you a universal formula, and that is good news for clear thinking. The boundaries do not weaken the finding. They tell you exactly how far the finding can travel. If you have been burned by confident advice before, this is why. The story sounded complete, but the limits were missing. Let us put both truths on the table. First, psychology belongs in the analysis. Inflated self-assessment, imitation, attachment to familiar assets, and the illusion of control can shape portfolio choices. Sometimes they line up with mispricing or speculative cycles. Second, those mechanisms are not universally predictive. Market design, leverage, who is participating, economic conditions, and policy can amplify or quiet them. Historical episodes can teach you how these forces interact. They cannot prove that every boom uses the same engine, or that every downturn was inevitable. Evidence earns trust when uncertainty stays visible. If you remember only one line from this video, make it this: confidence is information about people, not automatic information about the future. Here is the practical part, stated simply. Treat confidence as something to examine, not as proof of skill. Before a big money decision, ask a few plain questions. Am I relying on independent evidence or on recent performance, familiar holdings, and agreement from people around me? Where could this bold claim fail in another period or place? If someone manages money for me, are they making meaningfully active choices? What benchmark are they using? And do reported results include costs? Tools like diversification, long-term planning, scenario thinking, education, and behavioral coaching have all been suggested as ways to reduce bias. None of them erase uncertainty. Each can slow you down enough to think more carefully. That slower thinking is often the real upgrade. Next time you hear that investors are trapped by one hidden rule, pause at the word always. Ask what the data measured, where the pattern held, what counterexamples exist, and what changed when conditions changed. If you want market explainers that respect both the insight and the limits, subscribe and stay for the next one. Bring your own experience with you. Most of us have already lived some version of this story. Learning to name it is how we get better at not repeating the expensive parts.